All right, so unfortunately, we really bumped up against the limitations of this format last class when we were trying to do some of the Excel tutorial and Excel explanation. So that sort of class typically is going to be something that we do in a computer lab together. Usually, what happens when we go over that part in the course is I reserve one of the computer labs in the Hostler building, and I demonstrate the Excel stuff up on the screen at the front of the room, and then everybody has a computer that they can work along on in the lab, and then I can go around after explaining how to do it. I can go around and give individual help and give individual answer individual questions on how to do that stuff, and that's just impossible to do right now. And so I'm sorry about that, but I wanted to spend just part of the beginning of this class checking in on that to see if there's anybody that had specific questions or that wanted to see me demonstrate some of those Excel functions again at all. Are there any questions from last time specifically regarding the Excel lab stuff? I had put up some of those practice problems, and maybe you got a chance to try those. But is there anything you want me to try to clear up now? And I'll try to do that as best I can on this platform here. Okay, so there's a question in the chat on the question of why you subtract the risk-free rate, which is a good question. That's part of what I want to make sure people understand. So typically in a linear regression, you have y equals a plus b times x, and you're estimating that. And in the case that you're estimating this linear model, both of these, you have data. X is your data, y is also your data, and then this a and b, these are both parameters that you want to estimate. You want to choose a and b such that you get the best fit line between these two data sets. So if we have a plot, and we have this is the y axis, this is the x axis, and we have a cloud of data. There's going to be some line that fits that data, in which case the a parameter is going to be given by that position along the y-axis, and then the b parameter is the slope of the line. Now, so if we have both of those parameters free, if we're trying to fit a line through some of these data such that we minimize we minimize the sum of the errors, or the sum of the squared errors between each of the data points and the line that we construct based on the choice of A and B. If we're choosing A and B to minimize the sum of those squared errors, both of those are free parameters. In this case, though, we know something about what this y-intercept should be based on our theory of a portfolio. So if you remember our portfolio theory, we had some market portfolio of risky assets, and we had a risk-free rate, and we talked about how you can always achieve any combination of risk and return that's between the risk-free rate. This is expected return. This is risk. And just a reminder, this is the risky asset. You can achieve any combination of risk and return that falls along the line that's between the risk-free rate and the risky asset. So the risky asset is here. The risk-free rate is down down at the bottom left-hand side. That's the risk-free rate. So from our portfolio theory, we know that combinations of the risk-free asset and the risky asset mean that there's got to be a line that goes through both of those points, starting at the risk-free rate along the y-axis. So in fact, the fact that we know something about portfolio theory means that we're going to fix that a parameter. Actually, we're going to fix a equal to the risk-free rate, because we know something about how investors are able to combine a risk-free asset with risky assets. That tells us that the intercept for that security market line should go through the risk-free rate. So in a sense, we're not estimating a totally unconstrained regression. This would be, if these are both free parameters, that's an unconstrained regression. But we want to actually fix A equal to the risk-free rate based on our knowledge of portfolio theory. So we want to constrain A to be equal to the risk-free rate. One way we could do that would be just to directly impose a constraint that says make A equal to the risk-free rate. And if you have more sophisticated statistical software, you can do that. You can actually constrain certain parameters to be equal to one another or to be equal to other values that you want. With this Excel setup, it's a little bit trickier, and so we just have to do some manipulation to the equation first. So the way we do that is we just take y minus the risk-free rate equals to bx, and that becomes our. So then this becomes our new y, and then this is estimated with just the x data that we had before. So the structure of this new equation, this new regression model, right? That regression model, which is based on our knowledge of portfolio theory, knowing that the intercept term has to be equal to the risk-free rate. The fact that that's our new regression model means that when we estimate this in Excel and when we estimate this just statistically in general, our y data are going to be the returns on the particular stock minus the risk-free rate. That's the left-hand side of the equation. The right-hand side is just b times x. There's no a. So that's why we suppress the constant. That's why we selected the option for constant equal to 0 in our Excel regression. So that's why we subtracted the risk-free rate. It was basically to constrain the regression so that this intercept parameter, the intercept parameter A, would be equal to the risk-free rate. Okay, so that's the reason why we subtracted the risk-free rate. As we saw, if you're able to work out some of the examples in Excel, you'll notice that some of the different regressions that I had suggested, choosing different risk-free rates and different returns on the market as a whole. If you estimated those out, you'll notice that it didn't make too much difference at all. Which risk-free rate you chose. Changing it from 0 to 1.5 or 2.5 didn't change the estimate of beta very much at all. So it's not a crucial assumption, but it is theoretically correct if we are going to use what we know about portfolio theory to inform our estimation of beta. So that's kind of an explanation of where the why we subtracted the risk-free rate off of both sides of the equation, and estimated each of the individual stock returns minus the risk-free rate regressed on the S&P 500 stock returns minus the risk-free rate, because those are both the X and Y variables in the transformed regression model after we subtract the risk-free rate from each side of the equation. Okay, so I just want to hit one more time this idea of the security market line. So again, if we have a market portfolio of stocks, let's say that this red dot up in the top is the market portfolio. This blue dot down in the bottom left, that's the risk-free portfolio. Risk-free asset is that blue. On the x-axis, I'm going to say that this is the beta of an asset. This is the degree of co-movement between a particular asset and the market as a whole. And then up in the top, on the y-axis, we have expected returns. By definition, the market portfolio, that's just going to, by definition, move in exactly the same way as the market as a whole. A balanced market portfolio is going to have the same, it's going to move just with itself. Obviously, that's by definition. And so the beta on a market portfolio, that's going to be defined as 1. And then we can think about different assets as having different levels of risk in terms of their beta, in terms of what their co-movement is between the market as a whole and that particular asset. So, we have stocks that have beta greater than 1 or less than 1. And if we use the same principle that you can always combine an existing portfolio with a risk-free asset, the ability to combine any portfolio of assets, any portfolio of risky assets with the risk-free rate means that you can achieve any line or any combination of expected returns and risk that lies between the risk-free rate and the market portfolio. And in fact, you can even exceed the returns of the market portfolio. Yes. Okay. So let me explain beta greater than 1 here for a second. The market as a whole, a diversified market portfolio is going to have a certain amount of risk associated with it. There's a certain baseline level of risk that exists in the economy as a whole. You can't eliminate that amount of risk just by diversifying your portfolio. But there are going to be certain assets that are going to be even more volatile than the market as a whole. That they would, when the market's up, they're going to be up, 1.5 or 2 times as much as the market. So when the economy is good, these particular assets would be particularly good. Conversely, when the market's down, those assets would be particularly down. They might fall. If the market falls, they might fall by 1.5 or 2 times as much as the market as a whole. An asset that has those characteristics, that's what we mean by an asset that has a high beta. So if an asset has a beta of 1.5 or 2, let's say this is 1.5, this is 1. An asset that has a beta of 1.5 is going to, on average, it's not going to be a firm statistical relationship where you're always having everything move exactly in a predictable way, up and down. But on average, so if we think about what tends to happen between a particular asset and the market as a whole, an asset with a beta greater than 1 is going to just move move in the same direction as the market, but in an exaggerated fashion. It'll be gaining a lot. It'll be returning a lot when the market is booming, but when the market is down, it'll also lose a lot, and it'll actually lose more than the market portfolio as a whole. So an asset that has a beta of 1.5 would be something that would, if you add that asset to your existing market portfolio, your overall portfolio would become more volatile. And so it would increase the risk of your portfolio if you're holding a market portfolio. If you have something that's less than 1, adding an asset that has a beta of less than 1 is going to actually somewhat reduce the risk of your portfolio relative to what the market as a whole is doing. So in that case, the beta is just the degree to which a particular asset moves along with the market, either in an exaggerated way or maybe in kind of a muted way. The exaggerated way would be if it's greater than 1, if it moves in the same direction as the market in a scale down fashion, that's a beta less than 1, and on average that's going to be a lower risk asset. Something like the risk-free rate is going to have a beta of 0 because it's not related at all to the market. It's independent of the market. The market could be up, the market could be down, but the risk-free rate, which guarantees a certain return, is always going to be returning a certain just a certain amount given by that RF percentage, the RF percentage annual rate of return. And so in that case, there's no risk associated with that asset, and by implication, there's no systematic co-movement between the risk-free rate and the market as a whole. Does that get to your question? The question that was in the chat? Okay, excellent. And so one of the implications of this, we called this line the security market line. This was either called the security market line. Sometimes it's called the capital market line. All right, and so as long as any investor has access to a well-diversified market portfolio, as long as they have access to the red dot there, they can combine that with the risk-free rate to achieve any risk and return that lies along that black line. So in fact, if you're combining the market portfolio with say the risk-free rate, you're investing some of your money in the risk-free rate, some of it in the risky portfolio, then you'd be achieving any line along that yellow portion. But you could actually increase your returns. Okay, yeah. So let me just be clear about what this So the teal line is the security market line. That's either the security market line or the capital market line. That's what we would.
So are you saying you could use the terms interchangeably?
Yeah, those are synonyms. Yep, capital
Okay.
market line, security market line. There are actually, let me just point out, there is a difference between, say, this portion of the line, between the yellow and the red. That portion would be if you're investing part of your portfolio in the risk-free rate and part of your portfolio in a diversified set of stocks in the market as a whole. Alternatively, if you have something that's above the line, something, let's say by this purple portion, the purple portion, you're actually investing negative amounts of your portfolio in the risk-free rate, which means you're actually borrowing. You're borrowing at the risk-free rate. This purple portion means you're borrowing at the risk-free rate. You're borrowing at the risk-free rate, and you're investing even more than your total wealth in the market portfolio. And so you're going to have higher returns because you're not, you're getting market returns above and beyond, the risk-free rate that you would have if just investing at the risk-free rate. But when you're borrowing at the risk-free rate, you can actually increase your returns above the market. However, you are taking on more risk when you do that. When you borrow at the risk-free rate to invest more wealth than you actually have in the market, that's going to be something that increases your expected returns, but also increases your exposure. You're more exposed that way because you have all this leverage now, which you're obligated to pay back. You borrowed at the risk-free rate. You're obligated to pay that back at the risk-free rate, regardless of how the market is doing. And so you expose yourself to a little bit more risk by borrowing at the risk-free rate. But that would be the portion of this security market line that's above the red dot. That's sort of like this purple segment. That's representing the case where you actually invest negative wealth in the risk-free rate, which means you borrow at the risk-free rate and invest that in the market portfolio. Whereas the portion along the yellow line, that's actually investing, that's actually lending at the risk-free rate, earning that yield, earning that rate of return, and then investing some other fraction of your portfolio in the market, which is going to have an expected return that's somewhere between the market as a whole and the risk-free rate.
All right, so yellow line's just the risk-free rate and a combination of a portfolio, and then above it you're borrowing at the risk-free rate, and you're pretty much eliminating all your unsystematic risk, and you're just putting it all in the market.
Yeah, you're putting more wealth than you actually own in the market. You're borrowing, you're putting all your wealth in the market, but you're also borrowing money and putting that in the market as well.
Got it.
Whereas on the yellow portion, you're actually you're lending at the risk-free rate rather than borrowing at the risk-free rate. So the fact that you always have the opportunity to achieve any combination of risk and return along this security market line, the teal line, which is composed of the yellow portion and the purple portion, but overall it's the teal portion represents any feasible combination. Right, so that's the security market line. The fact that you always can achieve any combination of risk and return along that line means that other assets have to be returning something similar to whatever you could get along that security market line. So if there's another asset which has a beta that's less than 1, but expected returns that are below the security market line, that's not a desirable asset. No one is going to want to buy that asset because you could achieve the same degree of returns on that asset by simply combining the risk-free rate with the market portfolio in a different way. So say this I'm sort of running out of colors here, but this light blue portfolio, has identical returns as the orange, but it has lower risk. And that light blue portfolio is achievable by just combining the market as a whole with the risk-free rate. So this light blue portfolio on the security market line is unambiguously superior to the orange portfolio because it has the same returns but lower risk. So that would cause people to move away from the orange asset. That stock would be undesirable because you could always replicate the returns at lower risk by recombining the market with the risk-free rate. So the demand for that orange asset has to fall to the floor, and it's going to fall to the floor sort of until the returns net of the cost of that asset sort of push it back up onto the security market line. So the price of orange has to fall. The demand for orange is going to fall. That's going to make the price of orange fall. And as the price of orange falls, that's going to adjust the returns net of the cost of that asset, and so that's going to eventually sort of push it back up onto the security market line. And so in equilibrium, assets have to fall on the security market line. If they're off the security market line in some way, that means either they're totally undesirable or they are way better than the market portfolio as a whole, and so everybody would be wanting to shift their money into that that higher returning asset. So that's going to sort of require that all assets in equilibrium would have to fall along that security market line. And again, it's the ability to combine the market portfolio with the risk-free rate that makes any point along that security market line a feasible combination of return and risk. Okay, so that's sort of wrapping up this this idea of the capital asset pricing model. We've done some estimations of that beta in Excel. We've talked about the rationale why stocks in equilibrium have to be lying along that security market line. This is all leading towards our desire to know what a firm's discount rate should be. And the way we think about that is it's the weighted average cost of capital. And so there's a couple, there's some synonyms. There's some synonyms for this weighted average cost of capital. I might at some point call it the discount rate. Back in the section of the course where we were talking about investment decision rules, we assumed some discount rate and we discounted future cash flows by that rate. We were taking that as given. In this part of the course, we're going to be talking about where that rate actually comes from. So this weighted average cost of capital is synonymous with the discount rate that we were looking at before. It's also synonymous with this term required return. I think in fact we may have used this at some point when we were doing the previous assignments. I may have actually referred to this as the required return. So it's the cost of capital or the required return or the discount rate. Those are all synonyms for the same thing. It's the rate at which the financiers of a firm or the financiers of a project, it's the rate at which they have to be paid back. It's the rate at which they're going to expect you to pay them, something above and beyond what they invested in the company to begin with. So if we think about, we have some cash flows from a project, and we can either retain those earnings, we can retain or reinvest in the company, or we can take that extra cash and pay out to stockholders. That's what we typically thought of as a dividend. Now, remember, if we pay that money out to stockholders, they have cash. They can then take that cash and invest that in a nice, balanced market portfolio and earn a rate of return that's commensurate with with this market this market rate of return that we had been talking about. They can earn something equal to this this red dot on average, or they can combine that red dot with the risk-free rate in some fashion to achieve any expected return along that security market line. That's what investors could do if you just gave them the cash rather than reinvesting the money in the company. So investors, in order for them to be okay with you retaining the earnings, in order for them to sort of allow you, to reinvest those earnings back into the company, they are going to demand a payoff from that reinvestment. So the payoff to this retained earnings or reinvesting the earnings in the company itself has to be equal to what the stockholders could get. It has to be at least as good, it has to be at least as good as what the stockholders could get if they if they got the cash from you, if this cash was just given to them as dividends, if they got the cash from you and just invested that in their own, you know, market portfolio. So the payoff to this reinvestment has to be at least as good as the return on the overall market, right? If it's not at least as good as the return on the overall market, the stockholders are going to want their money, and they would prefer to have the money rather than have you reinvest the funds. So if you're gonna reinvest the funds, you have to convince them that it returns at least as much as what they could get in alternative investments, which are represented just by the sort of the market as a whole, which we looked at sort of in this analysis. So that's sort of the motivation behind this weighted average cost of capital idea, or the motivation behind the discount rate. So in that case, the right way to think about a project is that, you know, the right way to think about the discount rate for a project is that project has to return at least as much as what investors could get it with their money elsewhere. And so that's the appropriate rate to discount future cash flows from a particular project or a particular firm's activities. So the weighted average cost of capital is going to be that discount rate that we want to think about, the discount rate that we used in previous analyses. And this goes back, you know, we motivated this lesson with that concept, and so now we're sort of gradually building up to that, and we're using, you know, what we know about the capital asset pricing model to sort of inform our ideas about what the discount rate should be given the firms, the amount of money they've received from equity holders versus bond holders. So the structure, I think I'm just gonna have some time to go over the mechanics of this weighted average cost of capital. There's going to be some examples later on as well, but just the mechanics of the way that this weighted average cost of capital is constructed is it just as the name suggests, it's a weighted average. It has some weight placed on the return that equity holders require or shareholders require. So this RS is the RS is the required return to equity holders. That's in fact what we were estimating before when we were looking at the capital asset pricing model. We had the RS equal to the risk-free plus beta times the market minus the risk-free. That's in fact exactly what we were estimating when we were looking at the capital asset pricing model. So the required return, required return on equity is, you know, is the amount of return that you would need in order to tolerate a certain amount of risk. So for an asset that has a particular level of risk, remember that level of risk is measured by the beta. For an asset that has a particular level of risk, this security market line defines the relationship between the beta and the required return, and that's going to be an input. Now that's going to be an input into our weighted average cost of capital. That becomes a portion of this weighted average cost of capital. The first term, in fact, it becomes part of the first term in the weighted average cost of capital, where that required return on equity is multiplied by the share of the investment or the share of the company that is what was funded by the owners or funded by equity holders. That's the first portion, and then the second portion is the fraction of the company that was funded with debt, or the fraction of the project that was funded with debt. This weighted average cost of capital actually applies either to, you can think of it as applying to the firm as a whole, in which case the shares of debt and equity are what's on the firm's balance sheet on the right-hand side of the balance sheet. The liability side of the balance sheet, the amount of the assets that were paid for with debt relative to equity. But you could also think of individual projects as also having shares of equity and debt, where some fraction of the funds of the project came from owners, whereas some fraction came from bondholders, or the firm actually went out into bond markets and borrowed money to finance that project. So either way, the shares of debt and equity are going to matter for sort of weighting this overall required return, which is going to be composed of the required return on equity and the required return on debt. And then we'll talk about how that required return on debt needs to be adjusted by the tax rate given the tax treatment of debt. So we're at time. I'll stop there for now. Are there any questions about anything I've covered today at all? I can hang around again for a little while and take some questions just related to anything I went over. I'm happy to stick around to do that. If there are any questions before we leave.
I just had a quick question about the homework.
Oh yeah.
So if I'm looking at like the format you gave us here, so I know that in order to graph, like in order to use regression to graph the beta, you're going to take the market minus the risk-free rate, that percentage, and you're going to graph it against whichever stock you're comparing it to.
Yes.
So which one goes in the x-axis? Sorry, which one goes on the x-axis and which one goes on the y-axis?
Yeah, so it's the based on the equation that we were working with, we have the capital asset pricing model. Let me just write that. RS, which is the return on the stock, equal to the risk-free rate plus beta times the market minus the risk-free rate. So, of course, we subtract the risk-free rate, so we bring that over to the left-hand side. If we take that risk-free rate over to the left-hand side, we get something that's structured like that. And then in that case, this is that's our Y, and then this would be our X. So in that case, yeah, the stock, the return on the stock minus the risk-free rate is the Y-axis, and then the market returns minus the risk-free rate is the X-axis. And that just comes out of the structure of the capital asset pricing model equation, which is RS equals RF plus beta times RM minus RF.
Awesome, thank you.